For the last 15 years, shares of PepsiCo have been in a well-defined uptrend, and only a handful of times have shares tested the bottom end of that range. Now is one of those times. So at a time when all eyes are on Nvidia and Palantir and Google, do you take a crack at a consumer giant? Do you block out the noise and buy shares in PepsiCo on this 15-year uptrend? We'll look to answer that question and a whole lot more in today's video. Hey guys, hope you're doing well out there. It's time to check in with shares of PepsiCo after they reported their Q3 results. Year to date, this company has really not done much from a stock price perspective, basically flat over the past year to date. Over the past 1 year, you're up just 5.6%. And in fact, when you compare it to companies like its peers like Coca-Cola, it's significantly underperformed that, as Coca-Cola shares are up nearly 31% over the past 1 year, let alone compared to the S&P 500, which is up nearly 35% over the past 1 year. So do we expect shares of PepsiCo to begin outperforming its peers and also outperforming the S&P 500 moving forward? That is the key question we have to look into. Now, when you take a look at PepsiCo, the other thing you're buying into is a company with a 3.2% dividend yield, paying nearly $5.42 on a per share basis. You're also looking at a relatively inline valuation at this point. I'd say not egregiously expensive. So keep those things in mind as we walk through today's results. Now, revenues came in with $23.3 billion. That missed estimates, which were higher by nearly $500 million. That was also a decline year over year on the revenue side of basically 0.5%. Now, this isn't the full story because you have some organic revenue growth over at Pepsi, and then you have some inorganic revenue growth, which really accounts for their acquisitions and things of that nature. So we'll have to pay attention to the organic figure as well, which came in at 1.3% growth year over year on the organic revenue side. Now, where they did beat estimates is on the non-GAAP EPS side, as you had a small beat of 2 cents with EPS coming in at $2.31. Now, keep in mind, we just saw this company pays out nearly $5.40 on a per share basis. That's on a yearly basis. This company just put up close to $2.30 in a quarter. So you're looking at roughly a little less than 2 quarters worth of EPS that they pay out to you, the shareholder, in the form of dividends. Now, what you also got is this company revising full year guidance to be slightly lower. This is their Q3, and so they really only have one more quarter left in full year 2024. And so they have a pretty good idea of where they'll stand at the end of the fiscal year. And so they're now expecting full year results with revenues to grow in the low single digit range. Previously, the guide was for roughly 4% organic revenue growth. And so maybe you can expect 1%, at most maybe 2% organic revenue growth for the full year. Now, that is certainly disappointing, but keep in mind, this company has pretty medial expectations, especially when the stock price is basically flat over the past year to date. There's not a whole lot baked in to this company's results. The other thing this company maintained was at least 8% constant currency growth on the EPS side. So they're continuing to at least manage costs pretty prudently. And so they continue to see that nearly 8% increase on the bottom line for the full year. You're also getting pretty good returns from a shareholder perspective, as you have nearly $8.2 billion returned to you over the full year. Majority of that is through dividends. You also get a little bit in a stock buyback. We'll take a look at that when we get to the cash flows. Now, this company last week did announce an acquisition of a Mexican-American food brand called Siete Foods, maybe Siete Foods. I'm not really sure how to pronounce it. That acquisition closed for nearly $1.2 billion. It is pending regulatory approval, so we'll wait for that. But this acquisition really is another tuck-in acquisition that Pepsi tends to do every so often. Every couple of years, they tend to pick up companies that are sort of in that growth stage, but also early on, where they can maybe look to pick up that growth, but also make that company more efficient from a distribution perspective, because Pepsi is just so good from their distribution channels. And so they picked up SodaStream back in 2018. They also picked up Pioneer Foods early on. They picked up Rockstar Energy back in 2020, and then also did some other acquisitions back in 2020. So I think this really adds on to their portfolio. This also is a company that specializes in grain-free and dairy-free Mexican-American foods. So they're also venturing more so into the healthy snacking category, which I think, as we'll see, consumers tend to at least move towards from a Gen Z perspective. Now, that's also what they talked about on their conference call. They talked about healthier products, also relating more to the Gen Z snacking crowd. And I think an acquisition like Siete Foods really ties into that quite well. The other thing they talked about on the conference call was their partnership with Celsius Holdings. And if you don't know, they do have nearly an 8 or 10% stake in Celsius brands. And what they said about the partnership is they continue to like the partnership. They at least feel like they're delivering on their part of it, and their distribution points are going up, service levels keep going up. And so they really feel they are executing on their part of the partnership with discipline and high standards. They also remain optimistic about the partnership moving forward. Now, if you've kept up with Celsius stock over the past year, this company is at its 52-week lows, close to $28. I believe it's down nearly 70% over the past 1 year. And so certainly Pepsi feels like they're delivering on their part of the partnership. It's possibly Celsius that isn't delivering on their part, and certainly that is being reflected in their stock. I think part of it is Celsius not being able to prudently manage how their items will end up in Pepsi's distribution channels. Now, the other thing we got earlier, I believe yesterday, is you had some congressional Democrats accusing not just Pepsi, but other food giants as well of what is known as shrinkflation. So if you don't know, shrinkflation is basically maintaining the prices of food items and really goods while reducing the product sizes. So you might be seeing a Lay's bag that contain maybe slightly less chips than it might previously call it a couple of years ago, but still be at the same price point. And so you have companies like Pepsi, like Coca-Cola, like General Mills, basically participating in the shrinkflation. And I think Senator Elizabeth Warren, along with the representative from the state of Pennsylvania, were some of the Democrats accusing these companies of profiteering through shrinkflation along with dodging taxes. So I don't really know about the dodging taxes part, but I think shrinkflation definitely as a consumer is something I felt. Now, from an investor perspective, do I really think an accusation like this will have a material impact on these companies? I would say no. I think these companies are really good at managing what they do and really how they do it. And so I think because of the last couple of years, we've gone through extremely high inflation, and then we went through some extremely record high interest rates. Those are some factors affecting these sort of consumer staple brands and really food giants. And so I think an accusation like shrinkflation by Senator Elizabeth Warren really shouldn't have any material impact on these names moving forward. Now, the expectations for a company like PepsiCo really is quite muted moving forward. So for this year, you did hear that they said nearly 8% EPS growth is what they still expect for the full year. Moving forward into 2025, you're expecting nearly 7% EPS growth with a forward earnings multiple, not, I'd say, egregiously expensive, close to 19 times. I would think that is fair for this sort of company, really in line to slightly cheaper than the average S&P 500 name. It's also growing slightly slower than the average S&P 500 name. And then revenue growth in the upcoming year, I think, is far more important than the earnings per share growth, as you have nearly 4% revenue growth expected into 2025. So if this company can come in with maybe even just 5% revenue growth in 2025, I think that is enough to cause shares to move to the upside, because revenue growth really dictates how this company moves forward, because they've mastered pretty much the art of keeping costs low and really managing that cost portfolio. If they can continue to grow revenues, I think PepsiCo will be just fine. And certainly in this most recent quarter, we had some troubles with that revenue growth. And so moving forward, I think if you can expect shares of Pepsi to continue to move up, it has to be on the backs of at least 4 to 5% revenue growth. That's not something they delivered this year, and that's exactly why shares really didn't do much. They were flat. If they can continue to move the top line in the right direction, even just a couple percentage points, that I think is enough to cause shares to continue to move higher. Now, from their product portfolio perspective, you see Frito-Lay North America. This is the largest segment, the second largest segment of their business from a top line perspective, really staying flat on a year-over-year basis, slightly down. You also had the Quaker food side of the business continuing to just fall off a cliff. This is the part of their business they've done a recall on, and so both from a revenue but also from an operating perspective, just really turning into a non-existent business. This is one I've said that maybe they should look to offload, simply because they can't get enough leverage on that Quaker food side. Certainly if they can turn it around in the next, call it 1 year, the Quaker food side of the business should be something they absolutely look to offload, in my opinion. Now, the staple of the business remains the PepsiCo beverages on the North America side, nearly $7.2 billion in top line revenue. That translates closer to $1 billion in operating profit. Keep in mind, year over year, your operating profit on that side remains relatively low. And that's, I think, one of the reasons why a company like Coca-Cola has outperformed shares of Pepsi over the past 1 year, because when you take a look at Pepsi's beverage side of the business, yeah, the revenues remain relatively healthy to slightly growing. It's when you take a look at the rest of their product portfolio, really the snacks that this company has to offer, those parts of their business are really what's struggling from a growth perspective. And so Coca-Cola is more so a direct play on the beverage side. And I think that's one of the reasons why they've outperformed shares of Pepsi year to date. Now, because of that, I actually do prefer Pepsi because Pepsi has a more diversified product portfolio. They are in more categories. They're also more so into the food and snacking categories. I think that diversification and really being in all parts of the grocery store aisles, that is actually one of the main reasons why I prefer shares of Pepsi instead of Coca-Cola. Even though I think Coca-Cola is a more superior beverage brand, I think the diversification that you get with PepsiCo's product assortment, I think is something that's valuable to me. Apart from the North America side, they did see some strength in Europe as you had revenues tick up there. You also had operating profits on the Europe side continue to move up. You also had some strength in the APAC region, but Africa and again, North America really struggling. And considering North America is the largest part of their business, you really have to see strength from that top line in North America for this business to continue moving forward, despite I think pretty strong results in the Europe regions. Now, cost of sales coming in relatively in line, despite, again, losing some of that revenue dollars. They also brought down their cost of sales. So their gross profit actually ticked up nearly $200 million. So they, again, are really good at controlling the cost of sales. Anytime their sales slip, you'll see this company reduce those cost of sales really well. In fact, over the last 9 months, despite higher net revenue, their cost of sales is actually lower compared to 2023. And so that provides them with some gross margin leverage as their gross profits for the last 9 months up roughly $700 million. Now, what they weren't able to do, unfortunately, was control the costs on the SG&A side, as that actually ticked up close to $300 million pretty fast for this most recent quarter. As you see over the last 9 months, it's up nearly $300 million. So particularly this quarter looks pretty rough on an SG&A cost perspective. Now, we come down to the net income at nearly $2.95 billion last year. You were closer to 3.1. This company also paying a fair amount in net interest expense. When we get to their balance sheet, you'll see this company sitting on quite a large amount of long-term debt. From a cash flow perspective, we get to that $8 billion of net income. This is on a 9-month basis. That translates roughly to $6.2 billion in operating cash flow, significantly lower than same time last year. Consider the fact you have quite a bit of accounts payable that have changed over the past 1 year. You also have tax payments related to the Tax Cuts and Jobs Act. You also have some more restructuring expenses, also some product recall related impacts. So all of that really affecting the operating cash flows, down roughly $1.4 billion from same time last year. You continue to expect this company to spend on the CapEx side, building out those distribution warehouses, also the machinery and the automation that goes into PepsiCo facilities. I think that is one of their actually assets, if you were to ask me. Now, from a financing perspective, they did take on a little bit more in long-term debt, certainly as interest rates continue to lower. That should benefit a company like this that has a large amount of debt and continues to actually take on more debt over the last 9 months. So you had a little bit more that you took on in debt. You continue to pay nearly $5.3 billion in dividends over the last 9 months, and then you're on pace to do nearly $1 billion in stock buybacks over the past year. And so look, $1 billion in share repurchase, not something that's crazy, because a lot of that is still just mitigating stock-based compensation, but I think that's one of the ways you get your capital back as you invest in Pepsi. I think the major way still remains through dividends. Now, from a balance sheet perspective, roughly $7.3 billion in cash and equivalents. You have another $12 billion in accounts receivables. This company knows how to manage inventory, and so that inventory figure staying relatively in line. What you do have roughly is nearly $6.5 billion in short-term debt. And so from a current perspective, this company actually has more current liabilities, nearly $30 billion, than it has in current assets, coming in at $26.8 billion. Now, is that something I would be overly concerned with? No, not actually a lot, because this is still PepsiCo. It's a well-established brand, and this is a company that I believe does have the right tools in place to manage their balance sheet quite prudently. And then in terms of long-term debt, nearly $38.5 billion, again, up from same time last year. But yeah, $38 billion in long-term debt certainly is meaningful, and that does show up in the form of interest expense. Now, as you have interest rates beginning to be lowered, yeah, the interest they pay on that debt will also continue to come down, but I think will still remain a pretty sizable fact for this company. And I think if they can continue to pay off that long-term debt along with paying dividends and doing a share buyback, that's really all this company needs to do moving forward. So looking at the financials, it's not a great quarter. Certainly you had some declining businesses really across the board. It's looking ahead for PepsiCo that will really determine where these stocks will move. Certainly on the revenue side, if they can grow their organic revenue faster than I'd say 4%, I think that is your room for upside from a price perspective. Now, looking at the technicals, like we said at the top, a nearly 15-year uptrend is still intact with this company. You're at the bottom end of that range and you're not there all too often. Maybe 1, 2, 3, 4, maybe 5 times over the past 15 years you've come back and you've tested that range. Now, looking on a more shorter term basis, this is over the last 3 years. I'll zoom this in to make it a little bit more clear. The last 3 years you've been in this consolidation pattern, which is honestly a quite tight range, up from call it $160 all the way up to as high as $180. I think that is your range to continue to accumulate shares of PepsiCo. Look, if you are highly concentrated in a tech-heavy portfolio, I think a company like this gives you some pretty good diversification. It gives you that diversification into a consumer staple that is really, really well established. And so it lowers the alpha of your portfolio, no doubt, but it also, I think, lowers the risk of your portfolio, because consider the fact that over the last 3 years, you've been in a very, very tight range, up from 160 all the way up to 180. So you're not really having a ton of downside in a name like this, especially at a point where you're picking it up at not an egregious valuation, right around a 20 times earnings multiple. And so considering all those things, I think this is a range where you can continue to accumulate shares of Pepsi. You certainly don't have to go extremely heavy into this one. It doesn't need to be the largest holding in your portfolio. It just needs to sort of be there to help you sleep easy at night, maybe give you some dividends while you continue to wait for capital appreciation. I think your room for upside is all the way back up here, at least in the 200s, if not higher, moving into the 220s. I think there is certainly some room for multiple expansion. And then if Pepsi can continue to just deliver their consistent results of low to mid single digit revenue growth and then high to mid single digit earnings per share growth, I think there's really no doubt this company can certainly continue in this 15-year uptrend. You certainly do have to have patience with a name like Pepsi. It won't just rocket higher on no news. It'll do it very slowly. And while you wait, you're going to continue to get those dividends and that modest dividend increase. That was my take on shares of PepsiCo as the environment, I think, eases for this company from an inflation, from an interest rate perspective. I think that will prove well for this company to maybe perform better in a less challenging environment. The other thing is, I think, as interest rates begin to lower and maybe as investors aren't able to get nearly 4 or 5% in a savings account, they'll certainly look to move some of their money into companies like this that pay you a nearly 3.5% yield and do it at a very consistent basis while continuing to grow that dividend. So if you have patience with a company like Pepsi, if you're willing to maybe put part of your portfolio into sort of a buy and hold and you're looking for some dividend growth, I think shares of PepsiCo at this $170 range certainly could make sense. You also have a long-term 15-year uptrend acting in your favor from a technical perspective. Let me know your thoughts on this one in the comment section below as we get into earnings season with the major banks set to report, I believe, end of this week, and then you have some tech earnings beginning to roll in next week. Stay tuned on the channel as we'll be here to cover them all for you. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.